So very good afternoon to everyone. Let's begin with the evolution and history of mutual fund in India. So basically the mutual fund in India 1996 SEBI mutual fund regulations mandated the defined mutual fund as a fund established from trust to raise nominee or money through sale of units from the public. See, money has been raised from public. So it was a trust 1996 and this was introduced in India through SEBI regulations, and it was a mandate till the date defined mutual fund has established a trust to raise money through sale of units from the public. Then, if you see the history here, the history of mutual fund is a fascinating journey of growth, evaluation shaped by economic, regulatory, market developments. So early beginnings like 1700 to 1800, 1774, the concept of pooled investment began with the Netherlands. Dutch merchant Adrian van Kerkwijk created a first pooled investment fund called Angraat Market Unit creates strength. So unity creates strength because it's a pool money from public at large. The goal was to diversify investment and reduce the risk for small investors. So this was the beginning in 1700 to 1800 in Netherlands. In 1800, a similar pool investment scheme emerged in Europe and particularly Scotland, France. These were precursor to modern mutual funds. So this is how it was introduced. Then growth in the United States in 1920, 1930, 1924, the first modern mutual fund trust was launched in the United States. It was introduced open-ended structure. Open-ended structure, I already said that it is all about you just buy today, you sell today. It is open for any transaction. So Muscat's Investor Trust has been created. Then this was introduced to open-ended structure, allowing the investor to enter and exit at any time. This is what I was explaining about. Then 1929, the stock market crash highlighted need for greater regulation in the financial market. So 29 was the example about market crash. 1930, US government enacted regulation of Security Act of 1933, Investment Company Act 1940, ensuring transparency and investor protection. So this was very much important, where though investor would like to invest in the company in multiple growth or different method, but end of the day, transparency and the protection or safe security or safeguarding the interest of the investor very much was key. So in 33 and 40, Investment Company Act, Security Act 1933 was introduced. Then post-war expansion. Post-war expansion, 1940 to 1970, mutual funds gained popularity after World War II as an economic growth led to increased savings and investments. So 1940 onwards, mutual fund gained popularity, though it started from Netherlands. But 1940 was a really popularity after World War II as an economic growth led to increased savings and investment. The word savings and investments. So I was started with the first chapter. Is the meaning of saving and the investment is the same or unique? They are not same. They are totally different. Where saving is a proportionate of money earned and money as saved after deducting your expenses. But the savings has created the backbone of investments. Why? Because the saving money, the saved money is invested once again, which has to grow in future day. That saved money is in the name of income, in the name of profit, what you have been invested. So that has given the popularity after World War II as an economic growth led to increase in savings and investment. In 1950, introduction of equity funds focus on capital appreciation. So I said 1940 to 70, it was gained multiple popularity after World War and economic growth led to increase in savings and investment. And 1950, introduction of equity funds focus on the capital appreciation. In 1971, the first money market fund, reserve fund, was created, providing low risk option and option for short-term investments. So initially, nobody was ready for the long-term investment. I just kept this money for 10 years or 15 years, because there was no guarantee, nobody knows knowing that how this work. But initially, the first money market fund, we call a MMF reserve fund, was created, a low risk option, because nobody want to take care of risk. That's why they just want to go for the short term investment. And 1976, John Ball launched the first index fund, Vanguard 500, revolutionary industry at the low cost passive investing. So we have started from one country to another country and ended with the popularity, then coming with the different diversified funds, created one reserve fund. Then 76, first index fund was launched, revolutionary industry with the low cost as well as passive investing. Then comes the globalization and innovation, 1980, 1990s, and here 1980s mutual funds spread globally with countries like India, China, Brazil establishing their own mutual fund industries. So when this mutual fund, the investment revenue has been globalized, so it has grown like anything in form of investment and return. At the same time, it has reached to global level where funds spread globally. Countries like the example is given already, and many countries are starting owning their own mutual funds. So here investors invest in various schemes of mutual fund. Record of investor and their unit holding may be maintained by AMC, and it can be appointed register and transfer of agent, we call RTA. So here comes a real calculation about 1987. 1987, where in India government backed a unit trust of India, UTI, Unit Trust of India, introduced mutual fund to retail investors. So for the very first time, 1987 in India, the government backed Unit Trust of India, UTI, introduced mutual fund to the retail investor in the large market. Then the new types of funds emerged: sector specified funds, international global funds. This is what I said about classification of the types of funds. There was a sector specific funds, international global funds. Then in 1990, the rise of technology enabled the online platform for buying and selling and tracking mutual fund, enhancing accessibility. So you might be seeing the more focus which was given after 1980. So once it had been globalized, innovation took place, and the best example you can see, even olden days before 70s, where there was no much advancement or technology in any of the market, so buying and selling used to take with the paper. So when I buy some of the bonds and equity or shares or funds or mutual funds, I need to buy through paper. So I buy and I get a document, I get a paperwork to do, where I just maintain that paper as in my evidence what money I've been invested, and at the same time the same paper, or what we call the bond paper, or what we call the company initial paper, which has given to me that you are a account holder, you are the investor, you have this much account invested in this date, and it was very clear through paper and filing method, and there was no option of technology advancement online based platform. So people used to buy, people used to sell. Exchange of this paper was very much needed. Why? I just buy from somebody, I pay for that, and the paper was exchanged between one person and another person, because there was no proper technology enabled online platforms. But later on, if you see, after 1987, government backed with the UTI, introduced mutual fund retail investor. In 1990, the rise of technology enabled online platforms. So company has started with paperless work. So when it's come for paperless work, you can sit from anywhere, you can do a transaction, you can send the mail, or you can buy, you can sell through online platform itself. So one of the advancement of technology was very clear that this platform buying and selling is one of the main objective, tracking the mutual fund, especially the exactly how much fund you have been invested right now, what is the market, and where is your investment gone, whether you are declined, whether you have been increased, whether it is profitable, whether it's a loss. Everything was a very track recorded in under mutual fund under technology, and enhancing the accessibility for everyone. You might be sitting somewhere and you can go through for your investment and the fund realization, and the return expected, and the risk coverage. Everything was very visible and transparent. So 1990, the rise of technology was enabled online platform for buying and selling and tracking mutual fund. But today you can see the same online platform indulged for many things. It might be good and for the bad. But rise of technology in 1990, especially in India, so it was well advanced, and it was well taken into consideration in the name of advantage of mutual fund, where trust has been created in 1882. That's what they said. And this mutual fund trust is created one or more sponsor who are the main person behind the mutual fund business. So operation of mutual fund trusts are governed by trust deed, which is executed between the sponsor and the trustee. SEBI has to down the various clauses between this trust deed. This was the background of how this trust was created. Then after 2000 or present 2000 modern era, 2000 where exchange traded funds ETF exchange traded funds gained popularity as a low cost alternative to traditional mutual funds. So you might started exchanging between on platform that I buy and you sell, or you sell or go to buy, immediately money transfer, exchanging of funds through online platform. It was very easy accessible as it's paperless, and it was very low cost, less expensive as an alternative to the traditional mutual funds. So 100% before it is how this funds transfer in real time. But when it's come for the new modern method, exchanging of trade funds are very much classic concepts were given importance, and it has a high weightage because of advancement in technology. In post 2008 financial crisis, investors focused on regulated and transparent funds, boosting popularity of mutual funds globally. In 2008 financial crisis, so it might be seen 2008 and 9, it was a global financial crisis. At this time, people just started, instead of investing in the stock, they just gone for where less risk mutual fund at the global level, and it has gained very much popularity because people have been investing more and more in this kind of risk-free return funds. And 2010 emergence of thematic funds, ESG funds, environmental related stocks, and thematic funds. Already have been explained about thematic funds where money is invested in the infrastructure or the steel company or many other company, which is a emergence in 2010 emerging trend in of this company. Then robo advisors recommending mutual fund based on the algorithm. A technology has been used that uh, it's an automated technology as an advisor, artificial advisor, which was created, which was very much algorithm calculative. Like if you invest this much money in one particular year and how it is expected in form of future return, all this were automated recommended mutual fund based on the algorithm of a robo advisors. And today, if you see, the mutual funds offer a wide range of options from traditional equity, debt to niche product. Like one might be established one single product or a single fund or different variety in a single market, or niche as smallest to smaller with the margin based funds. Then you have a real estate investment trust, we call REITs, niche products, and cryptocurrency funds. Today you might be seen, nobody was knowing that 2010 people talks about cryptocurrency and it will gain to that level where no one was expected that this will give that return. And today in 2024, if you see, the cryptocurrency is a money market, money instrument. A future exchange is a cryptocurrency where the funds are exchanged not in form of any kind of a paper or notes or bills of exchange. It is about the online currencies. So crypto online currencies funds will take place the revolutionary in the future day. It is 0% less free, uh, less paper free concepts, and every exchange uh, in form of a online trading or cryptocurrency through electronic fund transfers. Then coming to the next slide here, Key trends in 21st century. It was a drastically shift to passive investing, like growing preference for index funds, index market-based funds, ETF, due to their own low cost and market matching performances. So today, as in passive investing, also I said that action, active as well as passive investing plans growing future. They think about the future as a positive index in the market growth and index funds, and they see that wherever the cost is low and the market match its performance. So that was this 21st century what the calculative today is happening. So digital transformation, the apps created, the platform which is created to make investing in mutual fund simplifier and more accessible, if you see. And today everyone has an access for various uh, YouTube videos or links or websites or kind of a business magazines or journals or real life situation market which is created where you trade in form of digital transformation, and apps was created in such a way that it become easy how investments are made today, and it automatically calculate if you invest this much money in this much year, and based on the component of interest what is the market index can be preferred. So what is the return can be expected from the market. So apps and platform make investing in mutual fund simplifier and simpler and more accessible, where it might be friendly investing in form of a friendly nature, and return is expected in that level. So where digital transformation makes a growing preference for every fund manager to become easy to sell and buy in simple manner. Then focus of ESG increased demand for sustainable, social responsible investments. Now I said in the previous class about the example about investing in the uh, EV, e-vehicles, and investing in the hydro projects, solar projects, and many other projects which are under sustainable, social responsible investments. Many of the companies drastically coming into this kind of a line. Especially, I said they are investing in defense manufacturing. There are different funds where it's a boosting in a country where money is funded in such a way that economy, the percentage of money is kept to manufacturing of this kind of infrastructure. So increasing and sustainable and the growth responsible investment is one of the key area in 21st century. Then global reach, investor can now easily access international market through global mutual funds. So people buy, sell then and now immediately. It is not only within, it is a global reach at any time, anyway. So that was easy accessible for every investor. And there is a fund manager who just go through for this international market and make help of everyone. So here, some of the key features of mutual fund flows in the definitions. So, mutual fund today, the industry is the worth of $1 trillion globally, with hundreds of thousands of fund option catering to diverse investor needs. This is the example we can see. Uh, when it started from Netherlands and it ended from various global multiplying with the money which is invested. That's why it's $1 trillion economy today and $1 trillion business today. Hundreds of thousands of funds have been options catering diverse investor needs. Different options are given, different multiple options are given where and why to invest and what return. So mutual fund today have evolved into a cornerstone of personal and institutional investment strategy, driving wealth creation of worldwide. So it is not about the profit maximization, it talks about the wealth creation about tomorrow. So mutual funds has evolved with the institutional investment strategy which has driven the wealth creation in the global context. Now if you see under mutual fund today, there are some of the fund features like they are established trust. Mutual fund is an established trust by trustee, and they raises money through sale of units from the public to the public or from the public. The units are sold under one or more schemes, and I can tell you the schemes invest security like money market instruments like gold related instruments or real estate, so many other options. In the market you have so much options where money is created, wealth is created, and the money being shared. So you have a AMC. Today you can see AMC, Asset Management Company. Day-to-day management of schemes is handled by asset management company and its managers. So this is how the AMC today is focusing in operations by created by trust deed, and this AMC is responsible looking into the portfolio of the investor for future. So thank you all. We'll see you in the next class.